Uh, Good afternoon, everyone. Let's continue to discuss this paper. Uh, is stockholders' diversity detrimental? Um, this paper actually is very interesting because my personal point of view and experiences, I only use 13F for examining institutional investors and the other dependent variables. I never use 13D and 13G data. So it's kind of, this data is not standardized. You must collect the data from the very original filing data. So it's very complicated. I think this is a huge work to making this paper rather than very simple data collection. You need to have a lot of skill to purify the data. So today we will see whether powerful owners can only monitor managers. But what if the owners disagree with each other? So this is the main issue and main focus of the Berkshire shareholders diversity. It's enhance value or destroy value. So we will continue to focus on this issue. This paper was published in Management Science, which is a top tier 1 journal in general management. So if a paper can be accepted, actually it's a finance paper, right? But accepted and published in general management science journal. So that means this concept can be applied to general management. So not just finance researchers benefit from here. General manager can benefit from this paper too. So first beginning, today we will introduce this paper addressing the research questions, data collection, identification. We can take a look at the identification of this paper because this is a paper design. And then we were talking about the results and the critic comments. So we will also answer whether the design is convincing because the paper using 13G delay filing. Some institutional investor actually is not so aggressive, so sometimes filing data may delay. So this is a kind of another event for delay. And also, Berkshire shareholders type classification. I think the presenter already mentioned that the classification can be enhanced, actually, can be more detailed, and cumulated abnormal returns using market model, and also count the votes, lawsuit, and future performances for this paper. Traditional agencies theory tells us about the managers will be monitored by block shareholder and the manager. So two types of owners. So this is a traditional agency theory. So managers relative to shareholders. But this paper doesn't focus on manager relative to shareholders. It's focused on shareholders relative to shareholders too. So actually, this paper moved from the manager relative to shareholders to like a majority shareholders diversity, right? To another like a minority shareholder. If there have some disagreement in between, some shareholder might exist the market selling the stock, and the other majority shareholder may still stay in the market and hold the portfolio. So the conflict is not from the manager relative to shareholder, it's from the shareholder to shareholder. We can see the majority to minority. So this is another type of research questions that can be accepted, I think, by the editor because it's another agency problem. There have some other conflict. So horizon or the goals or the governance style might be different between majority and minority shareholders. So, for example, I access the data from Bloomberg. You can access it too. Some company for individual, like a case, NVIDIA's large shareholder, Vanguard, BlackRock, already 17%, and the other capital asset management company and the others. This is the individuals, right? So this paper separate the ownership structure, have individual, have mutual fund or hedge fund, but it's different from we usually see in the database. So this is a very original finding data. So here we can see that NVIDIA have almost 70 to 76% of shares owned by institutional investors. So you can see the top holders, how many type, how many block type here. This is from the top to, can you see how many type of block diversity? This is one type, right? Vanguard, BlackRock. These four belong to financial institution, isn't it? It's not hedge fund, or yes, hedge fund. But these four belong to one block, right? The same type. So how many block here? How many different type of block from the top holder? This is one type, and another one is individual, right? So at least two type of block. And here you can see the individual mutual fund, hedge fund, and the other type of the paper doesn't mention because it probably below to 5%. And it also exempt the ownership larger than 5%. So below to 5%, it ignored, has been ignored. So hedge fund in NVIDIA is only 1.45. Okay, so this is one case that you can take a look at the, what is the four type. And it did not usually happen or observed in every company. Another case, Tesla. It's a very different ownership structure because individual, Elon Musk, have 24%, larger than the other financial institution, right? So here you can see at least two blocks of type, and the third one, others. If we separate into type, combine with, take a look at the, we can align for this. Individuals is this one. Mutual fund combined with all these financial institutions. And the other public funds, government, pension, and hedge fund actually relative to small. So this is another type that individuals hold large portion of a company. Very few firms have this kind of structure. Here is the same one we just talked about, and TSMC. So this paper doesn't measure the total amounts of the ownership, but it mentioned that it's very important when the share holding change. So here is another table from Bloomberg that you can access to. Sometimes if the individuals or the institutional investor change their ownership for some reason, then you can see the time and the percentage of the shareholding change and different type. So recently you can see that the C.C. Wei is the CEO of TSMC, and all these are individual insiders. So they actually played the role as a buyer significantly during this month. And on the other side, the other institutional investor, we can see that all institutional investor actually is from the sales side. So two types have the opposite trading strategy. Some purchase for individual insider, but the others play as a seller role on the other side. So why block shareholders matters in corporate governance? Because a large shareholder may monitor manager through voting, engagement, or pressure, or activism, or finally exit the firms. No longer own your ownership, sell the ownership in total. So when a firm can have multiple block holders, they may not want the same strategy. So there have some conflict. So in our translation, we will see that not more owners have better governance because the monitoring have some conflict, depending on whether the monitoring is coordinate or conflict. So both sides have paper addressing. Some papers say that monitoring diversity enhance the value because it actually cross monitoring can enhance different value. But this paper focus on the conflict. So there have some different results. If you check the literature review, you will find the opposite results. And the paper using the data 10 years ago from 1998 to 2016. And the original data is from SEC filing. So the paper, what's new in this paper? I just mentioned that 13F we usually use, but only focus on financial institutional blocks rather than non-financial. Here, the data focus on financial and non-financial because they include the individuals in the data set. And The other innovation idea is they use the block holders type rather than the numbers of the block holders. So using types and also the numbers. And this is a very special design for delay 13G disclosure design because it usually the firm will filing the 13G in February. So the paper summarized usually from February 1 to February 7, and it used the February 14 in the middle as this is deadline to isolate the market reaction to newly reviewed block shareholders composition. So before February 14 and after February 14, there have some release. So the market will react for this new entrance or new exit. So there have some mechanism tests for the impact for the stock price and also doing some fund performance using Tobin's Q profit margins, return on assets, and long or short portfolio returns. So this paper studied not just whether owners monitor, but whether different owners can govern together. So this is new from the paper. And I think you might have some idea that keep this in mind because you already know the presentation and have some original idea about this paper, but I still want to know because there's maybe some noise, maybe some opposite, some negative, some positive. And how did you think and expect block shareholders diversity to do? Can you guys answer this? You answer now, and at the end of the class, you can think about whether your answer in the first beginning is consistent. At this moment, what's your thoughts right now? At this moment, we haven't discussed a lot. Multiple choice. If block shareholders diversity, you may stand on the positive side or negative side, or depends, or you have no idea before checking the results. Can be multiple choice. Okay, we have 11 votes, 12 votes. Okay, so in our class, actually, we are very positive about the diversity, much more, because diversity creates some governance cross-check and may reduce risk. But this paper, let's see. Okay, so this is our result. We have improving monitoring for the large portion. So this is our result. 83% positive improving monitoring and information collection, And we have 33% may have conflict, like these papers addressing, and depending, conditional. Okay. Let's take a look at 3 different filing. These 2 is larger than 5%. Shareholder larger than 5% will presented in 13D and 13G. And this is usually for active institutional investor. This is usually for passive institutional investor. So core identification setting this paper using because delay revelation is about like February 14. So this is a different D and G, active and passive. And F, 13F usually is quarterly statement. It only focuses on financial institution. And Form 345 focus on insiders, individuals. So different filing include different ownership structure. The authors actually do the large, huge work. And here is the detail about 13D and 13G. So often, a passive institutional investor can be delayed till February 14. And this type of a passive investor usually just the last day will report. Okay, they will not release the financial statement earlier because it can be the deadline February 14. They will release on that day. And 13D is more active. Also, they will control the ownership and may have purpose for the transaction. File release is very quick and very detailed. Compared with 13F, they usually only identify financial blocks only and cannot capture all non-financial blocks. So using this data may have some bias. So this paper using D and G separate into 4 types: individuals, other identity, hedge fund, and financial institution. And they exclude hedge fund. And hedge fund this is a hedge fund that includes financial institution. If this is a financial institution, they excludes hedge fund. So both of them are not in the same type in this paper. So we have some introduction about the active. So passive institutional investor is like index fund or benchmark. Active institutional investors is like, we can take a look at the next page. Active like a hedge fund, mutual fund, public pension fund, and asset manager. These have voice, engagement, voting, proposals, or give board a lot of pressure. So they may create conflict when active investors engage. So this is quite different. But passive institutional investors is like an index fund. So recently we have a ETF 0050. Remember that? Very popular in Taiwan. And then it's an ETF. So this is belong to passive funds. And the other like the index tracking mandates or asset management index units belong to this passive. So these kind of funds usually will not engage in trading, corporate strategy, decision making, compared to active ones. So must be very careful to classify passive and active. So this paper categorical the total ownership into hedge fund is very aggressive, right? Individual and financial institution, a large portion of financial institution, and private and identity. So did you guys have any question about the category of 4 types? Financial institution, we just look at the NVIDIA, Tesla, we can see like a BlackRock, Vanguard is belong to financial institution. And other like a pension or hedge funds is another type. Okay, so paper only focus on 5% largest. So it's a different category compared to the other paper. So hedge fund activisms will have voice, voting, proposal submitted, and give the board pressure. They actually have the decision making indirectly influences of firms. So active, if agreement is not compromise to each other, may access the firms. So this is active IO will do. And passive one compared to is last discretion to sell. This is a buy and hold and to receive the dividend. So the other like a personal wealth tied to the firms is the individuals. Maybe the founder or the family ownership or the founders or the very original owners. These like individuals. So did you guys have some idea about the ownership structure type? So 2 hypotheses, one is hurt, the other is enhance. So this paper may focus on the conflict, inconsistent, disagreement, uncertainty, or lawsuit, and this may hurt. But the other papers may focus on performances. Then the paper have to talk a lot of cross-monitoring, benefit, information producing, and also activism plus passive, positive or very silent work pack logic may benefit a firm. So what is a work pack? The paper actually not assume diversity is bad. It actually tests 2 opposite hypotheses. And one hypothesis actually is not very significant. Okay, it's not consistently negatively. Some is insignificant, so we cannot conclude some conclusions so strong. And can anyone say something about the war pact? What does this word means? If you have an idea, you want to enhance to firms or influential, give them some influential on firms, what will you do? When you see this term, you feel it's a positive term or negative term for a firm. More positive or more negative. This is hypothesis 1, and this is a hypothesis 2. Richard Yo. Hypothesis 1. 1A or 1B? 1A. Okay, so different perspective in complex firms, like activisms plus passive or pack logic. But yeah, in some way it's negative, but in some way maybe positive. What is a war pack? It's kind of like some, like a Disney, you guys have a presentation, right? Disney case. Finally, the manager win rather than the activism wins. But you have to organize all the board director to make a decision. So this is like this kind of a logic. So depending on the situation. The data from different type of database. Financial data, compute state. Market data, stock return from CRIPS. SEC age guard data from 13D, G, and F, form 3, 4, 5. And Thomson Reuters from 13F, ISS voting, and the other lawsuit from Wells Law. Very large database merging paper. So even though that is a little out of date, but one authors or two authors can use such a huge database and combine it together. It's really make a lot of efforts. I think this is one reason. Another one reason that the editor will accept this paper. Compute state, CRIPS, ACEC, Thomson, ISS, Wells Law. And this is the observations, large sample, unique firms, 10,000. So 72% firm with 2 blocks, and 47% larger than 2 block type. And different block holders, they have 20,000. Sample is out of date 10 years ago, but it's also 10 more years. So how to count the homogeneous and heterogeneous? If example A, there are 3 financial institutions. This is one type, right? So the type is 1. And there have 3 Vanguard, there have a BlackRock, there are Fidelity, for example, and then you have a number of blocks 3. But this is one type, homogeneous. Example 2, plus hedge fund. So we have 2 types, right? And then we have 1 firm, 1 hedge fund. So we have 2 blocks. But because we have a different type, we already had a heterogeneous. So this will belong to heterogeneous. And then we have 3 different type. We are in heterogeneous. And each one we have a different block. So more heterogeneous. So more type, more heterogeneous. If no other holders larger than 5%, then will be given a 0, and then will be excluded from the database. So the authors have to classify which one, which type, and belong to heterogeneous or homogeneous. And you have to, because 20, see how many? They have a unique block holders, 20,000. And from there, you have to categorize into financial institution, hedge fund, individuals, or other identity. Only pick ownership larger than 50. So this is the general summary statistic. We can see financial institution holding period is the largest one. They're holding in long term, 20 years. Even though smaller stake, very diversified, but holding period is much longer compared with hedge fund. Hedge fund hold also very long, larger than my expectation, and large portion, and more active, more voice-orientated hedge fund, very aggressive. Individuals, you will be very surprised. If not every individual is like Elon Musk, because it's a founder, they may hold larger or long term. But the other individuals, holding period is very short. Okay, so the size is also very large. Can you imagine who they are? And the others, like other identity, there have some statistics only. So figure 1, 2, 3, let's take a look at that. From figure 1, we can see, can you imagine over time, more homogeneous or more heterogeneous? In the sample and from your logic, over time, each firm's block shareholder type is inclined to more homogeneous or more heterogeneous. This will be presented in figure 3. But what do you think? Is more homogeneous or more heterogeneous? Like one firm, you say from the beginning, start very small. And you say that it's homogeneous. And your case say, after that, finally, well, heterogeneous. But the direction may be correct, maybe not. We don't know. But figure 3 have this conclusion. Over time, they found that, but this is 10 years ago's data, not nowadays. So figure 3, it say that homogeneous blockholder base become more common among firms with multiple blocks. Figure 3 is saying that more common, homogeneous over time. So I am very surprised. And figure 1, take a look at that. Average number of blocks over time rise, right? So it makes sense over time. Number of blocks rises. And become more common is in financial and hedge fund. Make sense or not? So take a look at the graphing. Here is the figure 1. We can see the light blue here is a financial institution increasing, right? More common, large block. And in total, we can see the average number of blocks is increasing because the high is getting larger. So average number of blocks is increasing, and among them, financial institution library is increasing in common. followed by H fund. It's like a light blue. And in figure 3, we can see the pink color. Pink colors exhibit the evolution of block diversity in the last 2 decades. So you can see the pink color is a homogeneous space. So we can see the paper saying that over the time periods, the homogeneous blockholder base is increasing, more common. Ferns tend to be more homogeneous in type, in block type. Yeah, for some reason. Also, the author using this graphing to convincing reader that because in reality, the result is the same as what we do, what we find. We find that because conflicts destroy value, and we find that in over time, it's actually increasing, more common, reduce the diversity. So it's very interesting also, different from what I expect. I'm very surprised about the paper, the results that's more common in homogeneous rather than heterogeneous. And delay 13G is also a very good setting, I think. The paper find that February 14 is a very special day, right? In America, this is a very special day, Valentine's Day. So it's really interesting, and firm will filing at the 13G nearby this day. Usually like February 1 to 7. They will not file earlier. If earning report, the deadline is like a May 5th. Usually firm will filing like a May 4th or May 5th. Very few firms will filing the quarterly report a large ahead of the deadline, just nearby, 1 day, 2 days around. So this is February 14 emerged in this paper. So before that, after that, so we just set everyone February 14, and we check the market reaction. If they have some release, market reaction will from like February 15, February 16. We don't need to check every day, every firm's announce date. We just setting all use February 14. That was easy to design the paper. So after 15, that's a day 1 window. 16 is a day 2 window. Okay, so the paper is very smart to simplify the time spent. So beta is diversity increase. So it's not the level, it's an increase, change, percentage change. So if increase, how about the accumulated abnormal returns? Okay, control for the other fixed effect and many others. Also, this is a very standardized baseline regression model. So they find that this is February, for example, is the February 14 release date, deadline. You have to release. And after that, we can find. If block diversity increase, this is one group. So for this treatment group, after this day, if your diversity increase, we find the CAR, abnormal return, significantly reduced. And for the other control group, they did not have diversity change. So maintain the same pattern is kind of very flat. So that is a very good parallel trend to convincing readers that after the release date, we can see increase in diversity firm group significantly reduce the market return. And this is why the author picked February 14, because from the past experiences, they have a clusters analysis. Very few in January and very few in March, usually just in between here. So pick one day is February 14. And very interesting window. Release date, 5 days, or significantly reduce market return. Put the windows much longer, coefficient is increasing compared to 0.90, and this is a 0.93, right? So when diversity increase, we can see the market return react negatively and significantly along last for 10 days. Okay, the 10 days. And another interesting is placebo test. This is another benchmark comparison. Why we have to do placebo test? Because if this happened, could it be different if we change something, one different, just as the block was already reviewed. If another type, we choose another sample, which is the block already reviewed, not the newly releasement in the list. So if this is a sample compared to the releasement February 14, and then we can see that it's insignificant. So that means the newly releasement actually have some significant impact on market return because we compare to placebo examine, which is insignificant. Without this newly releasement impact, there have no impact at all. So size effect also find that different block size. Larger, much lower, significantly. So we can check the table, increase, not the level. It's increase, we can see that from table 5 days later as a significant. It's less to 10 days, right? Increase. Variation of change. This is a new releasement. Placebo is insignificant because I already know that it's already reported in other filing. It's not a news. It's not news already filing in other report. Okay, so it's quite important that diversity increase, they find the market model from day 5 to day 10, market react negatively. And also the change, also along with the change in standard deviation of the size. So some conclusion, not every block holder is equally bad. Okay, so the paper actually do not overclaim the benefit or overclaim the destroyment about the large shareholders. There have some clearly value enhancing blockholder combination too, but they did not identify that. So they did not overclaim the benefit because they don't do that. But they're also addressing some negatively impact, but very conservatively. Usually support the negative and the neutral effect, not all negative, not all bad. Okay, so hedge fund individual is not clear harmful. Okay, because the some coefficient are positive but insignificant basis on the small sample. So you can take a look at the homogeneous. We can see that homogeneous is much harmful compared to heterogeneous. If there is heterogeneous, then we can see that usually it's fine. 1 star only 10%, this is not very significant. So depending on original, you are homogeneous. If you are homogeneous, then add a new one, then have some negative impact. If you already in the stage are heterogeneous, and then you add a new one, there have a very trivial impact. So this is an interesting story. And also, entering what? Entering hedge fund. Entering hedge fund actually doesn't hurt anything. Could it be? And the others are different. Bot type already present, and then any increase might have some impact. But if the broad type entering without any present, hedge fund doesn't hurt much. Usually, firms actually like hedge fund to the firm. They may say that the company may have some positive impact. Stock price may goes up because hedge fund join the portfolio. So here is another one. How do you think before you take a look at the results? Which one do you think? Because we probably have no time. If you feel that it's a large, complex firms, more problematic. Which one you think? Is a small firm with high uncertainty or mature regulated utility firms with stable cash flow? Which type of firms, larger diversity might cause problems? I mean the more negative results. Small or large? Small or large? Is a large 10K. A small firm with a shortened 10K. Which one will be more problematic? You, Chen Yan. Huh? Small. Okay. So, yeah. The answer is here. I mark with black. It's a small firm. Okay. Only for small firms. If you're large firms with a lengthy 10K report, the problematic or the negative impact may be less. Okay. So actually, this paper, I think this is a really good paper, and then there have some size effect for large firms and short firms, small firms. We can see the coefficients are different. Okay, so diversity and different type, negative influences, consensus. So consensus means the analysis consensus. If the consensus is high, that means analysis have the same buying or selling strategy, or recommend this stock or disagreed with this firm. So consensus is high. That means the analysis have the same report about buy and sell the firm's stock. So this is negative. Diversity will reduce the consensus and will reduce the vote supporting management. And shareholder proposal, on the other hand, enhance is positive. And there is a very important diversity actually reduce the non-financial blocks present. Okay, so this is another disadvantage for diversity. It's not good for non-financial block. And this is the Windows lawsuit. So significantly increased the lawsuit. 1 year later, 2 years later, 3 years later, all lawsuits last longer and persist. And other robustness tests also negative. And this is the conclusion and the debate. I think our presenter already think that it's a very good comment on the paper. Short-term and ESG doesn't mention at that age, error is not quite an issue. And they're mixed type and imperfect status. Yeah, all this can be enhanced in the future research. And if you have time, you can answer this, because I think this is a good questions, but no one comment on this paper, because we find that the negative results, but there have no endogeneity test in this paper, right? So could it be the negative effect really caused by block shareholders diversity, or does the diversity review firms that already had hidden problem? So the market return negatively is the results or is the cause? Okay, so you can answer that if you have time. But today we probably will not answer too much. But this is a very good questions for the endogeneity test. If you can think about that, this is another paper that we can do for further researches. Any other questions? Okay, then if no questions, our class will end here. Okay, and thank you all for participating the presentation and discussion. And we will see you next week.